Ryder System just delivered a strong beat on their own internal expectations by raising their full-year guidance.
Yeah, the headline numbers paint a really specific picture of how they're handling this freight cycle. Comparable earnings per share came in at $3.73.
Which is, what, a 12% jump year over year?
Exactly, up 12%.
Damn.
And total revenue hit $3.3 billion, so a 5% increase. Operating revenue landed at $2.7 billion, which gives them a 3% bump.
Right. And looking forward, management actually felt confident enough to raise their full-year comparable EPS forecast.
They did, yeah, to a new range of $14.40 to $14.80.
So if you're holding this stock or, just looking for a place to park capital during a macro downturn, the mission for today's deep dive is to unpack exactly how Ryder pulled this off.
Yeah, because this is their 7th consecutive quarter of comparable EPS growth.
Which is wild in this environment.
It really is. So we're going to tear down their segment performance, decode what's actually happening beneath the surface of their margins, and analyze management's commentary on the freight cycle. Plus, we definitely need to look closely at their capital allocation strategy.
For sure, because the composition of that growth is where the real story lives. I mean, when you see a 12% EPS jump in a sluggish macro environment, you kind of have to look at the mechanics.
Right, you do. And a significant portion of that bottom line EPS beat was mechanically fueled by share repurchases.
Which obviously shrinks the denominator of the EPS calculation.
Exactly. But I mean, that financial engineering only works because of the massive fundamental earnings growth happening specifically within their Fleet Management Solutions segment, or FMS.
Right, FMS. So if FMS is the engine pulling the rest of the train here, we need to look at how that engine is actually firing.
Well, total FMS revenue was $1.56 billion, which is a solid 6% increase.
But the top-line revenue isn't really what jumps off the page, is it?
No, not at all. The earnings before tax, the EBT,
Yeah.
that surged 20% to $150 million.
Wow.
Yeah. And EBT margins expanded by 180 basis points, hitting 11.5% of operating revenue. I mean, for anyone outside the logistics space, a 180 basis point expansion that's nearly a full 2% bump, that is a massive leap in an industry that is literally notorious for razor-thin margins.
It's huge. And the drivers behind that 20% profit surge really come down to two primary levers.
Okay, what are they?
First, you have strong, predictable performance in their contractual business. That's the choice lease side of the house where, revenues are locked in for years.
Which insulates them from the spot market volatility.
Exactly. But the second lever is the used vehicle market, which is actually providing a rather incredible tailwind right now.
Wait, really? The used truck market is actively driving double-digit profit growth for a leasing giant?
Yeah, just look at the pricing dynamics. I mean, used truck pricing was up 6% year over year, and used tractors were up 3%.
Oh, wow.
And if you isolate the momentum, like if you look sequentially from the first quarter into the second quarter, retail pricing improved even faster. Trucks are up 7% and tractors up 3%. Okay, let me try an analogy here to kind of map out the mechanics of this strategy for you, the retail investor. It sounds like Ryder's FMS segment is operating much like a ruthless, highly efficient real estate landlord.
I like that. How so?
On one hand, they're optimizing their rental income, right? Just squeezing higher utilization out of the properties they currently hold.
Right.
But then on the other hand, when a tenant's lease is up, instead of just re-renting the property, they're successfully flipping it at a premium because the used housing market, or in this case, the used truck market, is running incredibly hot.
That landlord analogy perfectly encapsulates the capital allocation strategy at play here. But notice that they aren't achieving that higher utilization by accident.
What do you mean?
They're actively forcing that utilization up by shrinking their available property portfolio. They deliberately reduced their average rental fleet by 15%.
So they just choked up the supply within their own ecosystem.
Exactly. And by doing that, their rental utilization snapped back up to a normalized 75%. They willingly sacrifice some top-line capacity to basically guarantee that the assets remaining on the books are generating their targeted returns.
So they're just parking or selling the excess trucks to make sure the ones left are constantly earning. That's smart.
Yeah, and on the flipping side of your analogy, their inventory management is completely airtight. They ended the quarter with 8,500 used units sitting in inventory.
Which is right where they want to be, right?
Perfectly in the dead center of their long-term target range, which is 7,000 to 9,000 units. They are pushing the metal through the pipeline really efficiently.
I have to push back on the sustainability of this, though. Because if you're an investor, you really have to understand residual value accounting.
Oh, absolutely.
When a company like Ryder puts a heavy-duty truck on their balance sheet, they have to estimate what that depreciated asset will be worth when they finally go to sell it years down the line.
Right. They make an educated guess on the residual value.
Right. And because used vehicle prices have remained so robust, Ryder is capturing a massive gain on sale that exceeds those historical accounting estimates. I mean, that is pure profit just dropping directly to the bottom line.
Yeah.
But, I mean, if the used truck market rolls over tomorrow, doesn't this massive 20% profit engine suddenly stall out? Like, are they structurally a better business, or are they just getting lucky on macro vehicle pricing?
That is a great question. The sustainability of those residual values is arguably the single most important risk factor for anyone evaluating the stock.
So what does management say about it?
Well, management is acutely aware of this tension. Their defense is that they have structurally overhauled how they actually sell these vehicles.
Okay, how so?
Historically, a lot of this metal would just be dumped into wholesale channels,
Yeah.
which, clears inventory fast, but it sacrifices price.
Right, you take a haircut on wholesale.
Exactly. Today, they're aggressively pushing more volume through their own retail channels, cutting out the middleman. For instance, their retail sales mix hit 56% this quarter,
Up from what?
up from 50% a year ago. So while they're undoubtedly benefiting from a cooperative macro pricing environment, they're also executing better on the actual sales floor. They're capturing every possible dollar of margin.
Fair enough. So they're controlling what they can control by moving the assets through higher margin channels.
Right.
But if FMS is thriving because they can flip physical assets like trucks, what happens in a segment like supply chain solutions or SCS where the product they're selling is, human labor and network efficiency?
That is where the story shifts.
Yeah, because when you open the hood on the SCS segment, the margin picture gets significantly darker.
The contrast between the segments is really stark.
Yeah.
SCS grew total revenue by a very healthy 8%, bringing in $1.47 billion.
But the bottom line went the opposite direction.
It did. EBT dropped 7% to $92 million.
So you have revenues climbing 8% while profits fall 7%.
Exactly. Which mechanically results in margin shrinking by 130 basis points down to 8.4%.
What causes a disconnect that severe? Like, how do you sell 8% more supply chain services and make 7% less money doing it?
Two structural headwinds hit them simultaneously. First, the automotive sector was a drag. They specifically noted lost business in that vertical. Automotive revenue was down 7% year over year.
Okay, but what's the second factor?
The second one, and the one that actually matters more for the long-term thesis, is the upfront cost of ramping up productivity for new business.
Okay, look. Whenever management teams cite the productivity of new business ramping up as an excuse for an earnings drag, my cynical alarm bells start ringing.
I don't blame you.
I mean, for a retail investor trying to decipher corporate speak, is productivity ramping up just a polite way of saying they deliberately mispriced contracts and lowballed competitors just to buy top-line revenue?
That's the classic fear, yeah.
Or is this a legitimate, temporary growing pain that will actually yield margin expansion next year?
To answer that, you really have to look at the physical reality of onboarding a massive logistics contract. When Ryder wins a new supply chain client, they don't just, flip a switch and start collecting high-margin checks.
Right. It's not a software subscription.
No. They're often taking over a 500,000 square foot distribution center. They have to integrate their proprietary warehouse management software to run parallel with the client's legacy systems.
Which sounds like an IT nightmare.
It's extremely complex. Plus, they have to hire, onboard, and train hundreds of warehouse workers and drivers. In those first 3 to 6 months, operations are just inherently inefficient.
So they're bleeding cash trying to get up to speed.
Exactly. You're paying heavy overtime because your routing algorithms aren't fully optimized yet. You're throwing expensive labor at the problem just to guarantee you don't miss the client's shipping deadlines.
Okay, so the revenue from the new contract hits the income statement on day one, but the efficiency required to make that revenue profitable takes quarters to catch up.
Precisely. It is a temporary structural bleed. And management explicitly noted they're already seeing benefits from optimizing their omnichannel retail networks.
So it's fixing itself.
Yeah. And furthermore, if they were truly mispricing contracts just to buy market share, you wouldn't see the strong contractual sales activity across all segments that they're reporting.
That's true.
Customers are signing on for the long haul, but Ryder just has to absorb that initial friction cost on the front end.
That actually makes sense. It's the necessary cost of future growth. But we also need to look at their third segment, dedicated transportation, or DTS, because the headwinds there were a bit different, right?
Yeah, slightly different story there. The DTS segment saw total revenue drop 1% to $600 million, and EBT dropped 4% to $36 million.
So both top and bottom lines shrink.
Right. The top-line decline was primarily a function of running a lower overall fleet count, but the earnings pressure came from a very specific line item,
Which was,
the adverse development of prior year insurance claims.
oh boy, the dreaded prior year insurance claims. Could you explain the mechanics of this for the listener? Because this is a massive hidden risk in literally any transportation stock.
It really is.
Yeah.
Liability claims in the heavy transportation sector have an incredibly long tail.
Meaning they take forever to resolve.
Right. Picture a Ryder truck getting into a complex accident in, say, 2023. The company's actuaries assess the damage and reserve, I don't know, $100,000 in cash to cover the anticipated settlement.
Okay, so the business moved on.
Exactly.
Mm-hmm.
But 3 years later, in 2026, the case finally goes to a jury. And due to the current legal environment, what the industry calls nuclear verdicts, the jury awards $2 million.
Wow. And suddenly Ryder has to take a massive charge in the current quarter for an accident that happened years ago.
Exactly. The initial cash reserve was just insufficient, so that adverse development hits the income statement today.
Were they able to offset that at all?
They're able to offset some of this unexpected pressure by pushing higher pricing through their contractual business, yeah. But it wasn't quite enough to prevent the 4% EBT drop in the segment.
Okay, so we've looked at physical trucks, we've looked at warehouse labor, and we've looked at insurance liabilities.
We've covered a lot of ground.
Now let's tie the entire enterprise together by looking at the ultimate arbiter of a business's health, the cash it actually spits out.
That favorite topic.
Right. This brings us to cash flow, CapEx, and capital allocation. Because despite the complex margin squeezes in the supply chain and dedicated businesses, the overall enterprise is generating a staggering amount of cash.
The cash flow dynamics are honestly the hidden gem of this earnings report. Free cash flow surged to $684 million for the first half of the year.
Wait, up from what?
Up from the $461 million they generated in the prior year.
A $223 million increase in free cash flow during a freight recession. What mechanism is even generating that kind of liquidity?
It's a direct result of capital expenditure management. They paid $832 million in CapEx, which is down sharply from the $1.2 billion they spent in the same period last year.
So they essentially just turned off the spending spigot.
Pretty much, yeah.
But how does that tie back to the actual operations?
Well, think back to your landlord analogy and the 15% reduction in the rental fleet.
Oh, right.
If you're intentionally shrinking your fleet to force utilization up, you are, by definition, not buying new trucks.
Ah, that makes perfect sense.
The reduction in CapEx is tied to the timing of their choice lease fleet replacement schedule and a deliberate pause on investments in the commercial rental fleet.
So that unspent capital just stays inside the business, transforming from operating cash into free cash flow.
Exactly.
And when you look at how they've structured the balance sheet, it looks like a fortress built to withstand exactly this kind of macro cycle.
It's very solid.
I mean, debt to equity sits at 259%, which is safely at the absolute bottom end of their target range of 250 to 300%.
Right. They aren't over-leveraged at all.
Return on equity is solid at 17%, and they're forecasting 18% for the full year. But here is the number that should make any retail investor sit up and pay attention.
The capital deployment capacity.
Yes. They have $4.5 billion in flexible capital deployment capacity mapped out over the next 3 years.
To put that $4.5 billion figure into perspective, that represents roughly 45% of Ryder's entire market capitalization. And it's available purely for flexible deployment.
That is insane.
When a logistics company can cover its heavy maintenance CapEx, pay its dividend, and still have billions of dollars left over to aggressively acquire competitors or buy back its own stock, that is a position of immense structural strength.
And they aren't just sitting on their hands either. Year to date, they've already returned $406 million to shareholders through buybacks and dividends.
Yep.
And they just authorized a brand new 2 million share repurchase program in the second quarter.
They're putting that capital to work.
Which actually brings me to CEO John Days' commentary, because he spent a significant portion of the report highlighting Ryder's, quote, transformed business model.
He did. He emphasized that a lot.
He pointed to specific strategic initiatives that are expected to deliver $170 million in pre-tax earnings benefits, with $70 million of that hitting the bottom line right now in 2026.
Right.
So synthesize this for the investor trying to value this company. Based on everything we've unpacked, the used vehicle flipping, the slashed capex, the aggressive share repurchases, is this transformed model truly making them resilient to the freight cycle?
Or are they just coasting?
Yeah. Are they just coasting on deferred maintenance and financially engineering their EPS through stock buybacks?
Honestly, it is the defining question for the stock. Because while cutting capex and buying back shares absolutely provides a mechanical boost to EPS and free cash flow, you cannot sustainably execute that playbook if the underlying operations are bleeding cash.
Eventually, you run out of levers to pull?
Exactly. But the transformation Diaz is pointing to is actually structural. Over the last several years, they have actively shifted their revenue mix to be heavily weighted toward long-term contractual lease agreements.
So getting away from the spot market.
Yes, they're deliberately reducing their reliance on the volatile, spot market-driven commercial rental business because that segment just gets crushed during freight recessions.
So they've essentially built a floor under their earnings. By shifting to long-term contracts, they've insulated themselves from the most brutal, unpredictable swings of the macro cycle.
That's exactly it. Furthermore, that $170 million in strategic benefits, that isn't accounting magic. It's coming from multi-year maintenance cost savings and operational efficiencies.
It's real operational improvement.
Yeah, the buybacks certainly amplify the EPS growth, but the underlying engine that stabilized contractual portfolio is what generates the steady cash flow required to execute those buybacks in the first place.
Which explains the ROE.
Right, they've proven they can maintain a highly resilient return on equity of 17%. Even when the macro environment is fighting them every single step of the way.
Which provides the perfect perspective to zoom out and look at Ryder's ultimate earning power. Because, let's face it, the freight market won't stay depressed forever.
No, it is highly cyclical. And CEO John Diaz explicitly noted that they are finally starting to see improving freight market trends.
Okay, that's a positive signal.
But more importantly, he highlighted that contractual sales activity remains incredibly strong across all three of their business segments.
So demand is there.
Customers are locking in long-term capacity, which indicates that broader corporate confidence in the supply chain is returning, or, at least stabilizing. Ryder has essentially proven they can execute their balanced growth strategy flawlessly during a downturn.
Which leaves you with this final thought to really mull over as an investor. If Ryder is managing to generate 12% comparable EPS growth, if they can expand their fleet management margins by nearly 2 full percentage points...
Which is still crazy to me.
Right. And if they can throw off nearly $700 million in free cash flow during a mixed-down freight cycle, what exactly is their baseline earnings power going to look like when the macro freight market fully enters a boom cycle?
That is the big question.
I mean, when global supply chains are suddenly screaming for capacity, when rental utilization maxes out naturally without needing to shrink the fleet, and when pricing power shifts entirely back to the asset owners.
That is exactly the massive upside scenario the market is attempting to price in right now.
And the real tension to watch here is, will that $4.5 billion runway for capital deployment actually be enough to capture all that upside? Or will they need to abruptly pivot away from share buybacks and dump that cash back into aggressive growth capex just to buy enough trucks to keep up with surging demand?
It's a fantastic problem for a management team to have, honestly.
It is, but it's exactly the dynamic you need to monitor. We'll be watching closely to see exactly how they deploy that cash in the quarters to come. Make sure you hit follow on the show for your daily dose of tight, no-nonsense earnings coverage. See you next time.